we're going to talk about third-party technology risk management, specifically building on foundational processes which many companies already have in place. As for the agenda, first we'll look at a current day breach example so we can frame our discussion. Then we'll look at a current day regulatory considerations. Next, there are 3 foundational processes we want to build upon. These include third-party risk management, technology asset management, and risk treatment or risk management procedures. Then we'll look at how we might leverage a risk-based assessment approach, and then we'll close out. Our breach example is with AMCA or American Medical Collection Associates. AMCA provided payment portal services to companies like LabCorp and Quest Diagnostics. In March of this year, the parent company of AMCA, Retrieval Masters Credit Bureau, discovered the breach as an anomaly of incoming fraud claims. Unauthorized access lasted from the prior August until March for a total of 8 months. In mid-May, AMCA notified Quest Diagnostics of the breach, which affected 11.9 million patients. Data in question included credit card numbers, bank account details, medical data, and personal information, including social security number. Quest Diagnostics announced the breach in the beginning of June. At this point, there is a considerable exposure of personally identifiable information, or PHI, protected health information, or PHI, and primary access number, or PAN. Compliance violations could cover several different regulations, including Gramm-Leach-Bliley Act, or GLBA, Health Insurance Privacy and Portability Act, or HIPAA, and Payment Card Industry, or PCI. A month later, the parent company of AMCA files for Chapter 11. They spent $3.8 million to notify 7 million people, and another $400,000 just to handle the incident, just to handle the specific incident activities. At this point, the already small staff was reduced to only 25 resources, just to keep the lights on. So we have a great example here of a small company lacking the information security capabilities to protect, detect, and respond to cyber incidents. A day later, LabCorp announced an associated impact to the financial data of 7 million consumers. Shortly after that, BioReference had 422,000 patients. This now puts the count at over 20 million. This resulted in Dana Nessel, the Michigan State Attorney General, triggering an investigation. Additionally, Cory Booker and Bob Menendez, they're the 2 New Jersey state senators. They wrote formal letters to LabCorp, Quest, and AMCA demanding an explanation. In short, how could the breach have gone undetected for 8 months? Now, I realize this is a global cyber talk. Just for context, Cory Booker is currently running a campaign for president of the United States. So you can see how considerable breaches like this can attract political attention and become compounded, resulting in even more reputational loss. By mid-July, 8 additional business partners have been verified as part of the breach. You can see the companies listed below. This now puts the count at over 25 million impacted consumers. Now for the so what. All right, so many companies contract with laboratories like LabCorp and Quest to run things as simple as routine blood tests. AMCA was a vendor of the labs. So really it's a vendor of a vendor relationship. If the consumer or patient is the affected first party, and let's say some of our companies on this call would be the second party, that could make the laboratories the third party, AMCA there are several different terms: third party plus, end party, fourth party. The point is, it doesn't really matter. As you've seen here, and you'll see on the next slide, it all fits under third party risk, and you're accountable for those issues as the covered entity. All right, we're gonna change gears. We'll look at our regulatory examples. All right, now again, this is U.S. centric, but it's typical of the explicit degree of accountability which is now being required. And just to give a little bit of context about this law, this is Title 23 of the New York Code of Rules and Regulations. It governs financial services. So that's abbreviated as NYDFS. You may have heard that. This is Part 500, which is their cybersecurity regulation, cybersecurity requirements for financial services companies. This took effect in 2017. Who does it impact, or who must comply with it? These covered entities include, again, they cover primarily financial services, but it really covers a lot. They may include insurance companies doing business in New York, licensed lenders, mortgage companies, non-US banks that are licensed to operate in New York, private bankers, service contract providers, state chartered banks, trust companies. There are some exemptions, but the limits are quite low, so it's not even really worth mentioning here. What do you have to do as part of NYDFS? Just a couple things. You've got to have a cybersecurity program. You have to have a policy. You have to have someone who's accountable for this. In other words, you have to have a CISO. Qualified resources and staff. You have to have an incident response plan and the ability to notify impacted parties within 72 hours. All right. Some other things that have come up, within 2008, there was formal filing of reports by the CISO, pen testing and vulnerability testing, biannual risk assessments, and then with one of the last milestones, the need for audit trail capability as well as application security. So it's quite rigorous in terms of controls, and it spells out quite a bit. All right, Section 11 of this ruling, it covers third parties specifically. And we'll cover just some of the highlights. The section of the rule is on the slide. So just a couple quick, we'll cover 5 quick points. Number 1, okay, there's the need to conduct risk assessments for third parties. So it's specifically called out. Number 2, you have to have minimum control requirements and criteria for those third parties. Number 3, the need to determine the adequacy of controls. Now, determining whether a control is effective requires formal control testing. You can't just identify the control. So this may include evaluating things like SOC reports as well as auditing. So you can see how the amount of rigor, oversight, and cost goes up. All right, number 4, control details are required at the contract level. Specific mention is given to multi-factor authentication as well as encryption. Now, elsewhere in the regulation, you'll see that non-public information, or NPI, it requires encryption. In terms of encryption, it requires encryption in transit as well as at rest. So although encryption in transit, it's been around, it's been a key control for some time, encryption at rest is really a newer level of maturity, and it's become an expense for a lot of firms. All right, number 5, last point here, the third party has to provide notification for the covered entities. All right. So you can see how some of this is spelled out specifically with respect to cyber for third parties specifically at this point. All right, now we're going to cover our foundational processes. So again, these are processes that every company would probably have in place. We're going to call out some specific features and things that we want to make sure that we can leverage so that we can mitigate the situation in the example that we addressed in the beginning with AMCA. All right, so just think about AMCA as we go through some of these next slides. Now, with respect to third party risk, okay, you need to have an overall third party risk management program. Alternatively, this might be run out of an area like the purchasing department in some companies. The unit of work is the active contract. So remember the old saying, you don't know what you don't know? You need to be able to rely on internal teams doing business with third parties only where there's a signed contract. Once it expires, you need to really cease doing business. And that's kind of easier said than done, you know? Think about, you know, you have an SOW and, you know, it expires and you have a couple more days of work that you have to do. What controls are in place in a given company to actually ensure that that occurs, right? You know, I think people have seen plenty of examples throughout their careers. All right, now the owner, okay? So each contract requires a true business owner to be accountable for the overall risk management. This shouldn't be an executive who's disconnected from running that business process. Many times I've seen decentralized storage of the contracts. It makes managing risk hard, all right? The best practice is to utilize a centralized system with secure workflow and self-service features to store the official contract record and maintain its key attributes, things like the term of the contract, updates to the contract, etc. Now, technology assets. Remember, this is about technology risk management. It's key to identify specific technology assets that may include software as a service, application providers, it may include cloud computing, which covers platform as a service, infrastructure as a service, third-party libraries, infrastructure, commercial off the shelf, right? I mean, the list kind of goes on, but folks, you get the picture here, right? It shouldn't be possible. It actually should be possible from the contract management system to have transparency into actually specifically what technology assets. So there should be some kind of look into the technology asset inventory, and we'll look at that on the next slide. All right, now we'll end here with our specific contract controls, and I think this is really where the rubber hits the road, all right? So inherent risk. So we want to start capturing the inherent risk of the information. How sensitive is the data being sent to the vendor in the event of a breach? How critical will the service be to the operation of the business in the event of an outage, which can result in you know, an opportunity cost? Is there a risk of regulatory fines, reputational loss, financial loss? Okay. All right, now data lineage. Just a quick definition. This is really the downstream flow of data elements and how they're processed. As the covered entity, do we know where else the third party might be sharing our data? So think of the example. If we were contracted with one of those laboratories, did we explicitly know that the data would be sent to AMCA as part of, you know, some integration project, you know, that might exist behind the scenes? You know, is the language in the contract to require a formal update in the event of a change to the data lineage? So let's say that the laboratories weren't using AMCA mechanism available to force an update to the contract so that, you know, the covered entity actually knows about this, right? Is that mechanism in place procedurally, all right? Now, the right to audit. You know, this has often been met with pushback in the past. The right to audit the third party, it's something which has, you know, it's been around for a while. There's nothing new here, but it's worth actually just saying. Okay. And then finally, the explicit control requirements. They're now becoming more popular in contracts. As an example, many covered entities want to tie in their software as a service-based internal facing applications with their SAML-based authentication solution. It provides a much better user experience while also strengthening the login process. While some software as a service vendors might lack this integration feature, explicitly calling it out up front, it actually, you know, it actually helps manage expectations, right? You know, I've seen this a bunch of times where, you know, the expectation of the covered entity is to tie everything through the SAML, but then, you know, we find out kind of the last minute that, hey, that's not possible, and then it ends up in a change request. So you want to know that up front. All right, we're going to talk next about technology asset management. Again, you're going to see some similarities with the prior slide. So number one is that we want to have a program. As with many other processes, something like technology asset management, it needs to mature in phases. Though commercial off-the-shelf solutions exist in the market, it's important to start simple and crawl before you walk, before you run. So there's a lot of advanced features here. That's where the accompanying program becomes important, so you can kind of manage that maturity, manage data quality, etc. The unit of work. So we talked about the unit of work being the active contract before. Now it goes a step deeper. The unit of work here, where really that inherent risk needs to be managed, it's the asset, it's the technology asset. Again, it could be an application, a microservice for cloud computing, infrastructure, or utility. Keep in mind that multiple technology assets might be associated with one contract. So, you know, it's not a one-to-one relationship necessarily. Each asset requires a technology owner to be accountable to manage its risk. You know, we'll cover that a little bit more on the next slide, but something to point out here, this is true even for software as a service type applications, where the business owner might sometimes overshadow or supersede the technology owner, all right? So it's true that you've got that business owner. The technology owner is the one that's going to manage, for example, getting the entitlements feed, you know, into the entitlement review processes. We talked about the integration with SAML. There's going to be security event monitoring, so getting the application integrated with the SIM solution. So there needs to be a technology owner as well. All right, automation. So as with the contract management, we want to have a centralized system with secure workflow and self-service. All right. I've seen, just to point out on the automation, I've seen in the past kind of the penny wise pound foolish, where they don't really rely on the technology owner. They rely on kind of a rolled up production manager to do that, but they don't always have all the details. So, you know, make sure that, you know, the key actor here is going to be your technology owner updating this record, you know, at various points in the life cycle. All right, now something to say about the contract. Again, we want to have that look from the contract management system to see what associated assets. We also want to have the reverse look. So we want to have a linkage back to the contract management system. I mean, why is that important, by the way? So let's say that we have a contract and, you know, the contract is going to expire soon. Well, we're going to have to manage some kind of migration or decommission project that might, be required as a result of that. So we want to have that visibility. All right, the asset record includes the technical architecture scope, right? And all the details. There's probably going to be a linkage with the configuration management database, or CMDB, as a lot of people may know that. However, in similar fashion with the contracts, the asset record needs to capture the inherent risk associated with the asset. Things like the data classification, the recovery time objective, the financial impact. So we want to make sure that those metadata, or those attributes, are also maintained alongside the asset record. All right, now just to end here, the key timing to manage risk for technology assets when it's either new or it's undergoing material change. As assets age, they tend to advance in their life cycle, moving into a period of less frequent change until they're finally sunset or decommissioned. Therefore, periodic review is kind of the third leg of that stool. That periodic review becomes that consistent way that you manage the third-party technology risk, especially for mature assets. It's at these times that it's possible to trigger the key control processes in your service catalog. Things like security architecture review, and an update of the business impact assessment, or the incident response plans, right? We saw a call out to incident response in the NYDFS slide, okay? All right, in the next slide, we're going to look at details around risk treatment. So let's get started. Again, we're going to see some similar call-outs here. We want to have an automated process, centralized system, self-service, way to manage the data or the items, right? Now, assessment capabilities. Self-assessment processes are used as part of a holistic risk management procedures. It's important to build on the logic for third-party technology into those assessment processes in order to quantify the gaps and the leftover or residual risk. I had the benefit of working for a technology risk function where conditional logic was used in the GRC solution to achieve self-assessments. So by enriching that logic for third-party tech, the collective set of technology owners was able to leverage, a single effective and efficient solution. So we didn't have multiple assessment techniques. They knew that they would go to one URL, do their self-assessment processes, whether it was an in-house application, an application service provider, whether it was infrastructure, et cetera. So that's something to keep in mind. Also, leveraging something like standardized type assessment processes for information gathering, that's become a lot more important in recent years. The benefit of that is people are familiar with the questions, right? So the more that the more people can leverage those standard type questions that are available in the market, that's gonna help, especially with third parties being responsive to your surveys, right? Another thing to keep in mind here is that you want to leverage the use of frameworks. So a lot of those standardized surveys, they have all different control mappings, all different lenses. You may be interested in GDPR, for privacy in the EU, or you may also be interested in, NIST cybersecurity controls. So leveraging those frameworks, it becomes important to have the different lenses, but then it also is a way for you to shorten or bridge some of these lengthy surveys too, okay? So having a good handle on what specific controls, it's also helpful to articulate kind of the control objective. Sometimes there's a little bit of a disconnect between the question and the control. So leveraging frameworks is helpful. And you know what? I mean, I can't stress this enough, right? You're still going to get people that don't understand the question. In short, you've got to have ownership of your program, and you've got to really. It becomes more about relationship building, being responsive to their questions, right? So, you know, the first time that you run a new survey, it's going to create noise, but you know, it's not necessarily about, okay, how perfect are my questions? It's how good of a relationship do I have with all of the technology owners and the third-party technology owners, right? So that I can, you know, kind of address those questions, build a relationship. Having the relationship is going to actually help you more at the end, in the end anyway. All right, you have to use a risk register to maintain that risk appetite and the notion of top risks. This helps ensure a consistent approach and security posture. All right, but before we use the example of a SAML-based authentication for a software as a service type application, if the organization has a particular view on the use of, let's say, a native login features for software as a service, the risk register can be used to reflect that and set the overall organizational direction. All right. Using issues and actions management type features within GRC, that can kind of make or break your program, to be honest with you. So having an efficient, a fairly efficient and effective way of using that, not having every single, you know, attribute exposed, but really tailoring it to the organization, I mean, that becomes key. Now, there are different response types. So remediation management, that's fairly intuitive. You know, you have to fix your issues. You know, we've had that for a while now, right? A greater amount of friction may exist around the notion of risk acceptance, right? What's important is not to get caught up on the bureaucracy that may surround the acceptance form. My general advice, that, you know, don't worry too much around, okay, this is how the acceptance, these are all the levels of, you know, approval that we require. You really just have to focus on mitigation, right? Always try to exhaust all the mitigation options within the reasonable scope of your BAU or business as usual, you know, budget, right? Then understand, if you still haven't mitigated the risk, understand what additional project scope would be required and seek that approval before you even get to the acceptance form, right? Effectively, you need to exhaust every option, but, you know, especially with respect to high risks, okay? All right, reporting. Standard reports, standard reporting should include both senior communication as well as operational coverage. You shouldn't have one without the other. Unfortunately, organizations sometimes make the mistake of focusing on the senior communication at the expense of the operational. However, if you kind of achieve a balanced approach, the senior reporting becomes a great way to show all of the, you know, operational remediation that you've been working on instead of being a noise generator. So just remember that you have to balance with both. If portions of the risk management foundation are missing, or if they're lacking adequate maturity, the third-party technology risk management program, it's going to need to operate some of these things independently, right? But the key point is you need to try to leverage these processes as much as possible. And if they're not good enough, you've got to support them and kind of get them up to maturity level behind the scenes. That's important, just in terms of good governance, and your stakeholders are gonna recognize that extra step that you've taken. All right, let's move on, talk about our risk-based approach. We've thrown that term around a couple times, okay? This slide shows how to leverage inherent risk to tailor your control assessment work in order to, again, arrive at that residual risk level. This is not meant to be prescriptive, rather it's simply, just here to illustrate, one possible approach. So, the point is that you need to tailor this for your organization. All right, let's just go. We don't need to kind of go into too much detail here, but let's just look at a couple things just to call out. So the contract review. This is going to be conducted across the board. So that's actually not part of your risk-based approach, but it is part of control assessment. That's why we put it here. Security ratings. This is a relatively new technique that you can subscribe to, you can pay for. There are a couple different vendors available on the market. It's meant to be quantitative, right? And it's kind of like a personal credit score, except for your vendor. All right. I've heard different viewpoints on how to apply this. In other words, do you use it, just on your lows? Do you use it just on your highs? There is an expense to it, so you have to consider that. But I would definitely look at that. It's a way to, kind of keep the staff that you need under control, right? So effectively, it augments your process. You just have to figure out kind of how you're going to leverage it. But it is something that's come on in recent years. It is data driven. It's definitely something to think about. All right, you see graduations for the other techniques, which include documentation review, self-assessment, and then finally auditing. All right, one quick note, one quick comment on the documentation review. The inherent risk in the presence of something like a SOC 1 report, it really should line up. All right, so a service that impacts your financial reporting process should have both a SOC 1 report as well as a higher inherent risk rating. Okay, so that's meant to actually line up, right? So you should have more documentation review with a higher inherent risk. Again, if let's say that you've got a SOX applicable app, it might be a high inherent risk. Okay, just something to think about. That question may pop up as you look at this slide. All right, we're almost done, folks. All right, let's just do our wrap up. So this end party technology risk, or the vendor of a vendor situation, it's real, and you have to manage it. Regulations now make the covered entities explicitly accountable for third-party cyber risk. In theory, vendors can no longer use the dog ate my homework argument. Also, something to think about, the notion of risk transference. I've heard people, use the term, well, we're going to transfer the risk to our vendor. Actually, that term kind of becomes twofold, right? Yeah, true, you're letting them operate the controls, but the risk management you still need to own. You still have to show mitigation. It's still got to be in alignment with your control framework, your risk management process, the whole bit, right? So just kind of keep that in mind. Watch out for the term transfer. Even though it's more work up front, you need to integrate with pre-existing foundational processes and leverage them. If you don't, and you look to roll your own, you really risk becoming an island and failing. Your technology stakeholders will not have the appetite for redundant processes. Sometimes program managers do this as some pre-existing processes may seem less mature. You really have the obligation to collaborate and partner with those sub-process teams and really just encourage their continued maturity. You know, you have to become their partner. And we talked about that just prior. The contract review needs to capture inherent risk, data lineage, which is really the downstream flow of information, like, for example, from the laboratories to AMCA, the right to audit, as well as the control requirements. Process owners need to be trained on the spirit of this review process and ensure they get things right up front. All right, that's very important. So if you have your inherent risk wrong, right, and you have the most relaxed, you know, inherent risk, let's say data classification, and then you realize that, oh, you've got highly confidential information that needs to be protected, it's going to require a whole different recipe of controls. So you really got to get things right up front. The life cycle for technology assets associated with the contracts needs to be diligently managed along with their inherent risk. All right, so that kind of goes without saying. Control assessment processes should be based on inherent risk. Therefore, getting the inherent risk assessments right is key. Consider enhancing your approach by using discovery techniques. All right, so use of cloud computing is really coming on strong. I know, you know, in a lot of different industries. There are machine learning type services which can actually, or I guess even regular expression checking, which can be done. But there are services which, out of the box, for example, in AWS, you can actually see PII type patterns, right? So it's very possible to set that up. Consider setting up discovery techniques. That'll kind of complement the manual self-assessment process in processes that a lot of us already have. Okay. All right. So look, that's the presentation. I think we're going to do some Q&A. You have my email up front. I think it may be easier to use LinkedIn. So if you want to send me a LinkedIn, maybe just when you send it in the note for LinkedIn, if you want to do a connection, just write EC Council so I know that it's coming from this presentation. We can go through Q&A right now, and I'm happy to address things offline as well.